Hello and good afternoon, everybody. Very nice to be here with you today. My name is Alexandre Pastermajan and I'm a lawyer at Deloitte Legal. And today I have the honor to speak about startup valuation and how legal can help with valuation discussion. So I would like to start the presentation with one of the key findings of our scale-up confidence survey 2025. As you can see, one of the learning of the survey is that funding confidence for startup and scale-up rises, but valuation concerns remain. As you can see in the chart below, for almost 30% of the respondents, they consider that the current economic situation has a significant impact on valuation. So clearly, valuation is top of mind for the funders and for the startup. So the question is, of course, why does valuation matter? First of all, it matters because the valuation will determine the equity and ownership structure of the company. If you do a financing round, the higher the valuation, the less the funder will be diluted. So it will really define the bargaining powers between the parties, and therefore also it will have an impact on the terms and conditions of the investment, for example, in terms of governance or in terms of rights that will be granted to the different parties. The valuation of one round will also set a precedent for the subsequent rounds. Obviously, each time you do a financing round, you will look at the previous valuation and consider whether the valuation increased or decreased. The valuation will also reflect on the growth potential and market credibility of the company. In the market, sometimes it is perceived that a company with a higher valuation is more credible. And finally, the valuation will also acknowledge and quantify the value of the intangible assets, the IP, which is behind the company. So, quite an important topic, the valuation, but at the same time, valuing a startup or a scale-up may be challenging. Why? Because a startup or a scale-up, it's typically they do not have revenue or very little revenue because they just launched their activity. Because there is no revenue, obviously, and a lot of cost, the startup is loss-making. It's operating at a loss. A startup, per definition, is a very young company, and so it has a very short track record. A startup is very dependent on financing round. The startup needs money to finance its activity, and without money, it has to close shop. And finally, for the investor, it's an illiquid investment. The investor knows when he will enter the shareholding of the startup, but it doesn't know when he will be able to exit. So that's all the challenges. So what we can say regarding startup valuation is that it's a complex and variable recipe. Its main ingredients are storytelling is very important, management team, a strong team is important, the experience, the bargaining power, and yield expectation. So as you can see, startup valuation is more of a subjective exercise than an objective exercise. And on top of all that, obviously, there is a different perspective between, on one side, the funders, and on the other side, the investors. The funder will say, okay, my product is ready. All we need to do is to sell it and scale it. On the other side, the investor will have a more prudent approach. He will look at the team, the competitors, the size of the opportunity, at various factors, and the investor will say, okay, what you did was the hard part, but now comes the very, very hard part. So there is a different perspective, that will create a valuation gap between the founder and the investor. And that's precisely where legal can play a role in order to find ways to bridge the valuation gap between the parties. So there are a few legal mechanisms that can be used in order to bridge the gap, or at least to facilitate the discussion around valuation. And today I will focus on 3 of those mechanisms: the convertibles, the value adjustment warrants, and the liquidation preference rights. So let's start with the convertible loan agreement. So what is it? A convertible loan agreement is a loan that is granted by the investor to the company. And in the loan agreement, the convertible loan agreement, the parties agree that the loan will be converted into equity upon occurrence of predefined triggering events. So typically, that would be, for example, an exit or an equity financing round. So typically, we see a lot of convertible loan agreement with very early stage startups, but also with later stage startups. For this case, mainly as bridge financing to finance the later stage startup between 2 equity financing. So the question is, okay, what's the link between convertible loan agreement and valuation? The advantage of the convertible loan agreement is that it's a way to postpone valuation discussion. When you sign a convertible loan agreement with an investor, you don't need to speak about valuation, because the way it works is that the conversion of the loan will be done based on the valuation of the triggering event. So based on the valuation of the next financing round, or based on the valuation of the exit. So we'll take the valuation of the triggering event, so a future event. We'll use the same price, the same valuation, and we'll do the conversion based on this valuation. Obviously, the CLA investor put the money earlier than the other investor. So in order to compensate that, typically what we do is that we take the valuation of the triggering event, but we apply a discount on this valuation to compensate the fact that the CLA investor entered earlier in the company. So valuation is challenging. You don't want to talk about that? Do a convertible loan agreement, and that will offer you a good solution. A few market trends regarding convertible loan agreement. So we see more and more convertible loan agreements in the practice because given the current economic situation, there are sometimes some delay with the equity financing. In the meantime, the companies, they need cash and do as a bridge financing, they use the convertible loan agreement. And because there is more demand for the convertible loan agreement, we also see in the practice that the terms of the agreements are more favorable for the investors. So, for example, I spoke about the discount that we apply on the triggering event valuation. We see discount up to 30%. And the loan agreement being a loan, there will be interest accruing on the loan. And in the practice, we saw sometimes interest up to 13%, so which is quite high and aggressive. And we see also that the investor want more favorable terms. So, for example, they don't want to be subordinated. They don't want the convertible loan agreement to be subordinated. They want to have the choice to convert or not the agreement. So that's the current trend that we see with convertible loan agreement. So, convertible loan agreement, we postpone the discussion. But, okay, what do we do if we cannot postpone the discussion, if we need to do an equity investment today? And that we still have a disagreement between the parties in terms of valuation. One other tool from the legal toolbox which is really, really useful, is what we call the value adjustment warrants. What is a warrant? A warrant is a security which is issued by the company and which will give right to subscribe newly issued share. So a value adjustment warrant is a mechanism where we use the warrants to correct the valuation based on specific milestone or conditions. So I will give you an example that will, I think, be more clear. But just before that, there is 3 variations of value adjustment warrants. There are the founder warrants, the investor warrants, and the IP contributor warrants. So the founder warrant is a way to a positive correction of the pre-money value, and the investor warrant is the other way around. It's a negative correction of the pre-money value. But I will give you an example of founder warrants. So let's take the example of a company. The founder is very confident about the company and is convinced that the company will be able to launch its product within 6 months. And because of that, he says, okay, the pre-money value of my company is 2 million. On the other side of the table, the investor has a more prudent approach. He says, okay, there are many hurdles to overcome before you are able to launch your product. I think it will take 12 to 18 months. So for me, the pre-money valuation is 1 million. So there is a big gap from 1 to 2 million in terms of pre-money valuation. So in this case, one solution is the following. The founder can say, okay, I agree to the lower valuation, so 1 million pre-money valuation, but subject to receiving founder warrants that will be subject to the condition that the company is indeed able to launch the product within 6 months. So what does that mean? If, as the founder said, indeed the company is able to launch the product within 6 months, then the founder will be entitled to exercise the founder warrants, and he will receive newly issued share of the company almost for free. And that will increase in its shareholding of the company from 50%, which is a shareholding based on a pre-money value of 1 million, to 66%, which is the shareholding based on a pre-money value of 2 million. So in other words, thanks to the value adjustment warrant, it will end up in the situation it would have been if the initial valuation was 2 million. And I think everybody is happy. The investor is happy because the company was indeed able to launch the product within 6 months. So that's very good for the investor because that means that the company will take a lot of value. And on the other side, the founder is happy because at the end, he was able to get the 2 million pre-money valuation. So very good tool to bridge the gap. The last legal mechanism I would like to talk about is the liquidation preference. What is the liquidation preference? The liquidation preference is a mechanism where the investor, the preferred investor, will have a priority on the distribution of the proceeds of an exit or a liquidity event. So, for example, if the company is sold, the proceeds of the sold, if there is a liquidation preference, will be distributed in priority to the preferred investor. So in order to understand the liquidation preference, I think there are 2 concepts that are very important. It's the multiple and the concept of participating on or non-participating. Let's start with the multiple. The multiple is the amount that will be paid to the investor in priority. We call it a multiple because it's usually a multiple of the invested amount. So let's say that there is a liquidation preference of 2x, so a multiple of 2. Then that means that the investor will, if he invested 1 million, will be entitled to receive in priority 2 million from the proceed. If it's 1x, then he will receive the amount that he invested. If it's 3x, then he will receive, you understand, 3 millions. That's the multiple. And then there is another concept which is very, very important, is the concept of participating and non-participating. So what is that? When the liquidation preference is participating, it means that the investor will be entitled to the multiple. So for example, the 2x, the 2 million. And on top of that, what remains of the proceeds after payment of the 2 million will be distributed among all the shareholders of the company, including the investor. So the investor will receive the multiple plus its pro rata of the balance of the proceeds. So basically, it's paid twice. When the liquidation preference is non-participating, it's different. The investor has to choose between either the multiple or to waive the multiple and just receive the pro rata of the proceed as any other shareholder. So the mechanisms are quite different, and obviously, if an investor has a liquidation preference of, for example, 2x, which is participating, that can be very advantageous and very generous for the investor. And that's where I want to do the link with the valuation. When you discuss about valuation, if you only look at the number, okay, it's a valuation of 8 million, that's not enough. You have to look at all the terms and conditions of the investment. Because, for example, an investor could agree to a higher valuation if, in exchange for that, in consideration for that, the founder accepts a very generous liquidation preference. Because the liquidation preference gives a guarantee to the investor to make a return on its investment. So if the investor is already entitled to a 2x participating, if the participating part, so the pro rata, is 20 or 25%, does not make a big difference because he has already been paid 2x his investment. So the point is that don't look just at the valuation, look at all the economic terms of the investment, because it can make a big difference at the end when it comes to distribute the proceeds of a liquidity event. And just to finish, a few trends about liquidation preference. So what we see in the market is that for the seed rounds, we don't see much liquidation preference. It's really start to kick when we have Series A, B, C rounds. The trend is more toward the non-participating liquidation preference, which is a good news for the founder. And for the multiple, yeah, it's usually above 1x. So we often see 1.5 or 2x as multiple. Yeah. And that's all. I hope it was clear. And if you have any question, happy to answer them. No question? Okay. There's a question? Okay.
There's a question. Is it always profitable for a company valuation to make the loan?
I mean, the advantage of the convertible loan agreement is that it's really easy to put in place. It's just a contract that you negotiate with the parties. So it's easy. It's quite cheap, so it's not expensive because you don't have to go to the notary. You don't have to draft special reports. So it's pretty easy to do. But is it at the end advantageous? I mean, it will really depend on the terms and conditions. If the company has to pay a very high interest rate, yeah, that may not be very advantageous. If there is a high discount, yeah. So it really depends on what are the terms and conditions that have been agreed upon with the investor. But I mean, for a young company that want to receive cash without too much paperwork, it's really a great tool.
And we have no more questions.
Simpson?
So yeah, that's it.
Okay. Thank you very much for your attention.